All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is January 16th, 2025. Our top story this morning, we got more earnings from big U.S. banks, and they continue to show strength. They look pretty good here. This follows yesterday. We had a lot of good bank earnings came in yesterday, likes of JP Morgan, Citi, Wells Fargo. This morning, we got from Bank of America and from Morgan Stanley. Same thing. It looks like, earnings beats on the top and bottom lines here. Net interest income, in particular at Bank of America, showed strength, up 3% year over year. Investment banking at both Morgan Stanley and Bank of America was good. Double digits, high double-digit growth in investment banking revenue. We got a lot of companies issuing shares, a lot of merger and activity, possibly a resurgence in the IPO market coming in 2025. And so we're seeing the banks are doing all right here. Noticeably absent, I don't hear a lot about credit losses. I don't hear a lot about net charge-offs or loan loss provisions. Now, I haven't dug into the balance sheets on these banks yet, so I don't know if there's something hiding in there. All I know is nobody's talking about it. And through the whole second half of last year, there was a lot of talk about rising delinquencies in credit cards, rising delinquencies in auto loans. Of course, commercial real estate is what it is. Zombie companies are what they are. But I don't hear a lot of talk about credit losses at the banks. It doesn't mean it's not happening. It just means they're not talking about it. So I'll be digging into that, and I'll let you guys know what I find in there. Other big stories this morning. We've got two big ones from British Petroleum here this morning. And these two stories, I think, are very closely linked. The first one is an article that's talking about BP warning of lackluster profits for this quarter. They're projecting weak results. They're also delaying their capital markets day, which is like their investor day. I think that's got more to do with their CEOs recovering from a planned medical procedure. But as far as the weak results go, we're seeing declining oil and gas production from British Petroleum, and we're seeing declines in refining margins. All right, both of those things are the result of inadequate CapEx in prior years under their past CEO. They didn't poke enough holes in the ground. If you guys know anything about the oil and gas business, these wells, when you first start them up, they are gushing, and then performance pretty rapidly drops off. And if you're not constantly poking holes, you're slowly losing production, but it takes a couple of years for that really to show in your results. So BP right now is seeing a decline in their production. Now, their refining margins are getting squeezed as well. Well, if you don't make the right investments in your refineries, most of which are several decades old, we don't build refineries anymore, you start to see their production starts to decline too. So BP is seeing they're paying the price for the mistakes of their prior CEO and his inadequate CapEx. And at the same time, there's another BP story out this morning that they're laying off 5% of their global workforce. 4,700 employees plus 3,000 contractors are being let go. Now, what they're not saying, because nobody in the press wants to address the elephant in the room, is that these layoffs are being centered in their renewables division. Because British Petroleum, along with all the other European oil majors, drank way too much of the Greta Kool-Aid. And they're like, oh, the energy transition is here. We don't need oil anymore because we built a couple of windmills. Nope, not how that works. And here we are 5 years later, their oil production is falling, and they're laying off all the windmill people because the things don't really work. Or they work, but not when you want them to, not when you need them. The energy transition, I've been saying it since I started this channel. That whole narrative of the energy transition has been just fake. Natural gas production and natural gas consumption has exploded while everybody's been like, look at my windmill and look at my solar panel. Carbon emissions have gone pretty much nowhere, guys. And with the rest of the world modernizing, it's only gotten worse. So you can see both of that in these BP stories this morning. I don't think U.S. oil majors went down that particular rabbit hole, but be careful of those European names. Also, we got some earnings results from United Health this morning, and they're dragging down the Dow. We got the S&P and the NASDAQ are both in the green here, but UNH is a big drag on the Dow. They posted an earnings beat, but a revenue miss. But also, we got some color onto the effects of that big cyber attack that happened last year. $9 billion it cost them. So that's having a drag on the Dow this morning. We also got some early results from Target. They're telling us that their holiday sales beat expectations. They were good, but they weren't great. Target's reporting that their Q4 comps were up 1.5% versus last year. Now, that's not great because remember, the inflation rate is about 3%. So if your comps are up 1.5%, yeah, your nominal sales have gone up, but you sold less stuff than you did a year ago. But even that 1.5% number, that is much better. The market was expecting the holiday sales to be flat versus last year. So initially, it looks like some optimistic news about the holiday shopping season. Now, the one thing here, though, profits were unaffected. Target is saying our sales were better than expected, but our profits were exactly what we were expecting, which means the reason why those sales were so good was because Target lowered their prices so much. In other words, the cure for higher prices is higher prices, as you may have guessed. No, the cure for higher prices is not investing $1.5 trillion in windmills and solar panels and printing money. No, it's higher prices. We got Blue Origin put a rocket in space. Another private company has reached orbit. All right. There's a lot of people that are out there like, oh, billionaires building spaceships. They're wasting money. We should take that money from them and use it to do whatever cause du jour I'm in favor of. I don't buy into that, guys. I see billionaires, whatever their reasons are, and maybe it's just, a measuring contest between Bezos and Elon. Whatever the reason, the governments of the world are no longer pursuing space flight and space exploration. Billionaires are. So they're getting the job done over there. I like to see another rocket in space. Remember when we used to do cool stuff? Remember when we used to build great big things and do cool shit with them? Well, we don't really do that anymore because there's an endangered nematode in the way, or, oh my God, some guy can't afford a haircut. We need to pay for that instead of doing awesome things. Whatever the heck reason, cause du jour, I like to see things going into space. So congratulations to Jeff Bezos and Blue Origin. Also, a moment of silence, if you will. I'm going to don my tinfoil hat just so I can remove my tinfoil hat as a show of respect to Hindenburg Research, the short-selling firm. They are closing up shop. They're calling it quits after 8 years. Hindenburg Research has done some freaking awesome work. Pardon, to put it mildly, Guy, what Hindenburg done has been nothing short of amazing. Now, there's a lot of people, especially since the meme stock movement, who have given short sellers a bad rap because there are some predatory short sellers out there who destroy perfectly good companies. That's not Hindenburg. Hindenburg Research has done an immense public service. They did it for their own financial benefit, but who cares? It's capitalism. Hindenburg has published some reports in their short tenure that took down the likes of Nikola, exposed them for what they were doing. Carl Icahn, the Adani Group. Most recently, Super Microcomputer, exposing that fraud with the help of my buddy Yorker Finn, I might remind you. And most recently, Carvana. Hindenburg Research and the short sellers there have served a vital public role of exposing fraud in finance. And there is so freaking much of it. Financial crime has become so pervasive in our society. It is everywhere. It's underregulated, underpoliced. It's under-prosecuted. And in the rare instance when it does get prosecuted, the penalties are quite often a fraction of the proceeds from the crime. In other words, just the cost of doing business. Hindenburg Research figured out a way to make money exposing that. Good for them. Yay, capitalism. They will be missed. I hope somebody will rise up and step into those shoes. Thank you, Hindenburg, for everything you guys have done for the last 8 years. With that, why don't we shrink my big melon of a head and let's see what's going on in the markets this morning. And don't forget that like button and that subscribe button if you're new here, because we do this every day. So come on and have your coffee with the melonheads as we go through markets. The S&P 500 right now is up 5 points, 0.09% to the upside. Stock's doing a whole lot of nothing in the S&P. We've got the Dow, however, down 126 points, or about 0.3%. That is being driven, I think, mostly by these UNH earnings that were not so good, and that $9 billion bill for the hack. UNH is the largest component of the Dow. Meanwhile, the NASDAQ is up 65 points, or 0.31%, just a little bit to the upside here. Looking over at the U.S. dollar, it is stronger this morning by about 17 basis points, 109.28. Notably, yesterday, we saw the dollar took a big drop on that, we'll call it a slightly lower than expected core inflation print. The dollar dropped pretty substantially. What didn't get a lot of press is that over the course of the remainder of the day, it clawed back all of those losses and actually ended up closing positive for the day. And here we are in positive territory again. Now, also interesting related to the dollar, we got this one this morning from Financial Juice. I guess the minutes from the last European Central Bank meeting have come out, and it turns out 50 basis point cuts were on the table. This is from the ECB accounts. Some members noted that a case could be made for a 50 basis point rate cut at the current meeting. This is referring to the prior one, and would have favored more consideration being given to the possibility of such a larger cut. There was other comments in these minutes that basically said, hey, yeah, we'd like to cut 50, but it might send the wrong message. The market might think we're panicking, that kind of stuff. But the reason I'm talking about this here, guys, is because the Federal Reserve is going to do nothing in January, right? The pause is going to happen. There's no chance, even with the inflation print yesterday, there's no chance of a Fed rate cut. And we're still really only looking at base case one cut for the remainder of this year. Meanwhile, the European Central Bank is talking about possibly cutting 50. They're heading in the other direction. So we've got the two main central banks here, the ECB and the Fed. They're drifting apart. That means a stronger dollar in the cards. Pay attention to this. If we see the ECB keep moving dovish as the Fed pivots hawkish, we could see a blowout in the dollar that will not be good for stock valuations. And that also means probably higher interest rates here in the States. Now, looking over at the bond market, we have got a lot of green here after they were deeply red yesterday. Yields dropped substantially yesterday, and they stayed down, even though the dollar recovered some of its losses. Looking over here right now, the 30-year Treasury, 4.890. That's up a point and change. The 10 years at 4.669, also up a point and a half. It was down like 14 basis points yesterday, guys. So this is just a little bit of a bounce, recovering a fraction of yesterday's losses. The 2-year, 4.287, that's up 2.3 points. And the 1 month is essentially unchanged here at 4.296. Also notable yesterday, despite the recovery in the dollar, gold held the gains, and they're continuing to take some more today. Check out spot gold back above $2,700. We got 27.16 for spot gold. That's up $19.75 this morning, 0.75% higher. Spot silver is at $30.77, up another 11 cents or 0.37%. I like the shiny. So we got gold and silver both clawing back a little bit more today. They were up big yesterday. They were up a little bit more today. Copper is up 0.25% here. Platinum is up 0.5%. Palladium is down about 0.9%. Oil's down a little bit this morning, 13 cents lower for March WTI futures, which are trading at $78.55. And natural gas is a fraction of a penny higher, still at $4.09, about 0.25% higher this morning. Also, Bitcoin held most of its gains yesterday, giving back a little bit of that this morning, but very briefly yesterday, we were back above that $100,000 threshold here. Right now, we're at $99,200 as priced on Coinbase, a little bit lower than this time. Well, actually, that's actually higher than we were this time yesterday. Important to note, we recaptured that 50-day moving average shown in blue there yesterday. Possibly going to retest that one today. The 50-day moving average sits at around 97,700. So watch that level and also watch that 100,000 level. Guys, I get the feeling, call me crazy, if we break out of this little consolidation pattern that we've been in for a couple of weeks here, if we break out above that, get back above 100,000, retest and stay there, I think Bitcoin probably makes a pretty quick move to about the 120 level. I know we don't have many Bitcoin fans on this channel, but keep an eye on that one, guys. There's still a lot of money sloshing around out there. Now, let's talk about some of these big bank earnings. Bank of America tops estimates on better than expected investment banking and interest income. And I think the market's going to latch onto that interest income because that is a very important category for the big banks. Bank of America on Thursday posted results that topped expectations for profit and revenue on better than expected investment banking and interest income. Earnings per share were 82 cents versus 77 expected. That's a beat. Revenue was $25.5 billion versus $25.2 billion expected. Also a beat. The company said fourth quarter profit jumped 47% from a year earlier when the bank had that $2.1 billion FDIC assessment tied to the 2023 regional bank failures, and a $1.6 billion charge tied to accounting on interest rate swaps. Revenue, meanwhile, jumped 15%. That's based on rising fees from investment banking and asset management, along with stronger trading results. Investment banking fees surged 44% to $1.65 billion, roughly $180 million more than expected. That indicates the company's bankers had a strong end of the year. And just last month, CEO Brian Moynihan told investors that investment banking fees would jump 25% in the quarter. Unlike with rivals, including Goldman Sachs, Bank of America's trading operations didn't significantly exceed expectations. Fixed income revenue rose 13%, roughly in line with street estimates, while equities revenues rose 6%, also matching expectations. But the firm said that net interest income, one of the most closely watched figures for the lender, rose 3% to $14.5 billion, exceeding estimates by $170 million. Good results across the board here for Bank of America, guys. And the stock is having kind of a muted reaction. It's up 0.5% ahead of the opening bell here, 0.4% higher, $47.33. Now, it's possible some of this was already baked in. The stock had a really good day yesterday. They were up almost 2.9% on those JPM and Wells Fargo earnings. So maybe some of this positivity was already baked in. Meanwhile, Morgan Stanley looking pretty similar here. Morgan Stanley tops estimates on strong equities and fixed income trading revenue. Morgan Stanley Thursday topped estimates for fourth quarter earnings and revenue as the firm's equities and fixed income traders exceeded expectations. Earnings per share of $2.22 versus $1.70 expected. Revenue $16.2 billion versus $15 billion expected. Big beat there on revenue. The bank's massive wealth management business will be helped by high stock market values in the fourth quarter, which inflates the management fees it collects. Big banks love stock market bubbles because you pay them a bunch of fees when you trade. Investment banking activity continued to rebound last quarter, jumping 29% in the quarter per DealLogic's figures, fueled by rising advisory and equity capital markets activity. And trading activity was supported by an eventful election season. In other words, they collected a bunch of fees because of the Trump bump. Morgan Stanley stock is up 1.75% this morning, trading at $132.50. That's after rising nearly 5% yesterday on those other bank earnings. So banks continue to rip here, guys. It has been a good couple of days for the banks. Now let's talk about British Petroleum because they put on a masterclass on how to destroy an otherwise successful company by, planting billions of dollars in CapEx around the whims of an idiot child. It's pretty much what they did. BP warns of weak Q4 results and delays their capital markets day. British Petroleum has cautioned investors about weak fourth quarter results due to declining oil and gas production, reduced refining margins, and trading setbacks. The company also revealed a delay in its highly anticipated investor day, originally scheduled for February 11th, now set for February 26th in London due to CEO Murray Auchincloss, I hope I said that right, his recovery from a planned medical procedure. He's expected to return to work in February, ready to outline his strategy for BP's future. BP's financial forecast suggests further strain with a $300 million drop in profits due to declining refining margins and maintenance activities. In other words, they haven't kept up with their investments in their refineries, and now they're paying the price for that. The company also expects a $200 to $400 million reduction in its oil production and operations unit, compounded by falling production levels and oversupply from new refineries in Asia and Africa. And those big reductions there in oil production, guys, if you don't maintain your CapEx in the oil space, your production number will start to decline within a few years. And look, in 2020, that was at the height of the ESG craze. It just wasn't very fashionable to drill holes in the ground looking for energy. The protesters would show up and, oh my God, my ESG score. And then they divest your stock from the pension funds. Well, BP's paying the price. They jumped knee deep into that crap. They were all about it. They forgot they're an oil company. They forgot to do oil things. And of course, now they're paying the price for it. And in totally unrelated news, we got this one in renews.biz. BP to cut 5% of workforce, 4,700 employees and 3,000 contractor positions will be impacted. In other words, people are getting fired. BP is to cut 5% of its workforce in an effort to reduce costs. Around 4,700 employees and 3,000 contractor positions will be cut this year, according to British energy company CEO Murray Auchincloss last year said BP would cut costs by at least $2 billion by the end of 2026 to boost returns and address investor concerns over its energy transition strategy. There it is. The energy transition strategy and investor concerns. In other words, this company lost so much freaking money on windmills that now they're having to lay off thousands of people. And their financials are suffering because they forgot they're an oil company and they forgot to drill for oil. A BP spokesman told RE News, "We are strengthening our competitiveness and building in resilience as we lower our costs, drive performance improvement, and play to our distinctive capabilities." In other words, we're not going to let Greta Thunberg run our company anymore. We're going to do what we've always done, which is drill for oil, and we're going to stop with the silly wind turbines. BP stock doing all right, all things considered here, up 0.5% this morning after it was up about 0.7% yesterday, trading at $31.44. Guys, this energy transition thing, it's always just been a PR stunt. It never sat right with me. The physics doesn't care about your political ideology. That's all it comes down to. Physics just doesn't care. It's physics. It has no emotions. And wind turbines cannot power a modern society that needs power 24/7. They just can't. Also going on this morning, United Health stock falls after earnings and revenue comes up short. This is the one that's why the Dow is down so much this morning. United Health stock fell after the healthcare company Thursday reported a mixed quarter. Shares were down 4.4% to $519 in pre-market trading. Fourth quarter adjusted earnings were $6.81 a share on revenue of $100.8 billion, beating expectations for the earnings per share, which were $6.73, but missing on revenue of 101.6 expectations. So it's that revenue miss that's probably hurting. Also, I want to send a shout out to Frog Capital on Twitter, who put this out today, and he was very quick to catch what's driving those lousy results from United Health. You'll notice here their net earnings, 2023, they were $23.1 billion, and now they're $15.2 billion. What happened? Well, the big change, if you go through their balance sheet, it was this category right here. Let's zoom in a little bit more on it so you can see it. Loans to care providers - cyber attack, a $9 billion loss for 2024. That is what's driving these lousy results from United Healthcare. That hack cost them $9 billion. And the stock is paying for it this morning is down 1.7% at $534. That's off by about $9 this morning. We also got some news on the holiday shopping season from Target. Target says its holiday sales were better than expected, but its profits weren't. In that latter half there, its profits weren't. That is a key here. Target raised its fourth quarter sales forecast Thursday after more consumers turned to its stores and website for holiday shopping, particularly on days known for deep discounts. The big box retailer now expects comparable sales in the fiscal fourth quarter to grow by about 1.5%. That's better than its most recent outlook, and the metric would be approximately flat. All right, so 1.5% comp growth in a 3% inflation environment, that's not very good, but it's a lot better than the nothing that the market was afraid of. And so this story is good news for Target if you look at it from that perspective. Comparable sales include sales on Target's website and stores open at least 13 months. Yet the Minneapolis-based discounter did not lift its profit outlook, an indication that deals motivated shoppers. Target anticipates fourth quarter earnings per share will range between $1.85 and $2.45, and full year earnings per share will be between $8.30 and $8.90. Target will report fourth quarter earnings results on March 4th. The company cut its profit guidance in early November after it posted its biggest earnings miss in 2 years and blamed some of its troubles on softer sales of discretionary merchandise and the cost of preparing for a short-lived port strike in October. So this is the first good news. We'll use that word good news. We'll use that lightly here, all right? But this is not horrible news, and we've had nothing but an endless stream of horrible news from Target for about 2 years now. So we'll call this story good news, not as bad as feared. But look, the market doesn't like it here. Stock's actually down pretty big on this news. It's down 4%, $129.07. It's off by $5.45 here. So markets continue to make Target pay here. Meanwhile, Walmart has done a lot better. This is the first indicator we've had about the holiday shopping season. At the very least, it means it was a little better than we were afraid of. It doesn't yet mean it was good. Target is one of the big retailers, but they're not the biggest. So let's wait until we get quarterly results from the likes of Walmart or an Amazon before we try to make that call. Also, Jeff Bezos' Blue Origin launches massive new Glenn rocket into orbit on its first flight. We don't need to go too into detail on this one, guys, but it is another private rocket has gone up into space. People are still exploring space. It's been a long time since we had one of those, like moon landing, really cool kind of stories out there. So victories like these are few and far between, but I like to see it. Even if I'm not the biggest fan of Jeff Bezos, I like to see people putting stuff into orbit. I think that is really cool. The rocket was successful. This was their first attempt, and they did reach orbit. They were trying to land it on a ship upon reentry. They weren't quite able to stick the landing, but that was always seen as more of a stretch goal, kind of like swinging for the fences. Overall, though, we'll call that one a success. Congratulations to Blue Origin. And influential activist short seller firm Hindenburg Research says it is shutting down. I was very sad to see this yesterday, guys, and I think the frauds and the crooks of the world are high-fiving each other right now, because every one of these companies that's out there that's channel stuffing, that's making undisclosed related party transactions, I think it was their worst nightmare to wake up one morning to find out their name is in the title of a Hindenburg Research report. So there's a lot of crooks and a lot of a-holes out there breathing a big sigh of relief on this news. Founder Nathan Anderson says he and his team are ready to move on to the next chapter of their lives just after 8 years. Activist short seller firm Hindenburg Research is calling it quits after an impactful 8-year run in which its reports took on high-profile investors like Carl Icahn, Gautam Adani, and helped take down companies like electric truck manufacturer Nikola. In an email to followers, Hindenburg's 40-year-old founder Nathan Anderson said he and his team were ready to move on to the next chapter in their lives, and that he wanted to spend more time with his family and other people close to him. There is not one specific thing, no particular threat, no health issue, and no big personal issue, Anderson wrote. I now view Hindenburg as a chapter in my life, not a central thing that defines me. In the few short years since Anderson launched the firm in 2017, Hindenburg, named after the famed German airship that exploded over New Jersey in 1937, repeatedly rocked markets with probes into companies it believed had engaged in financial malfeasance or fraud. According to Hindenburg's website, its research had led to charges from the SEC Commission against 65 individuals and federal criminal charges from the Department of Justice against 24 more. These guys took down a lot of crooks. So thank you, Hindenburg, for everything you've done. I think you guys did an immense public service. I'm sorry to see you go, but I wish you guys the best in all your future endeavors. And I just want to say thank you very much to Lisa B. Thank you, Lisa, for being a melonhead for 11 months. She's got an idea, a melon ball picnic YouTube handle name tags. Melon ball picnic. Is that a melon ball as in the drink? I've had a few melon balls. They're decent cocktails. They're a little fruity, but I like them. A melon ball picnic and YouTube handle name tags. Oh, so you mean like, hi, my name is Lisa B. Hi, my name is Melonhead. All right. We'll throw that one in the oven. We'll let that one bake for a little while and see what comes back. Thank you very much, Lisa B., for being a melonhead. And thank you, BTB Inc. Okay, apparently he's an LLC. Rumor, Russian CB froze all retail bank assets. First I've heard of that. I don't want to add to the rumor mill, but I will mention this. There was a tweet that came across this morning that Mish caught in his research. We were talking about it on our briefing. Russia and China are going directly to Saudi Arabia, trying to get their hands on an additional 750,000 barrels of crude oil per day. It looks like this latest round of sanctions, the one that's been targeting the shadow fleet and the insurance companies, is really taking a bite out of China and India's oil supply here. That cheap Russian crude that they've been enjoying since the invasion and the sanctions started, it's starting to go away. So pay attention to oil markets, guys. There's a lot happening in oil markets. We got the Saudis are on the fence. Are they going to increase production or aren't they? We've got a new domestic production-friendly regime is about to take power in the States. So that could lead to more supply hitting the market in the years ahead. Watch the energy space, all right? On top of that, all this nonsense from BP this morning. It's pretty interesting. As far as the Russian central bank and the retail bank assets, I haven't heard anything about that one, but I'll look into that, BTB. Thank you, sir, for the super chat, for supporting the channel, and for the tip. And thank you, everybody, for having your coffee with the Melonheads this morning. Appreciate that very much, guys. Thank you for the super chats. Thank you also to my magnanimous Melonheads on Patreon and YouTube for supporting the channel. Looking forward to talking to you guys tomorrow afternoon in our weekly get-together on Zoom. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Don't forget that like button and that subscribe button on the way out. Until next time, live small and dream big.